America is showing no signs of clamping down from the aggressive stance, prompting China and the European Union to warn of a global recession. Large manufacturers have already started taking big decisions like shifting production to another part of the world. Well, what does all of this leave countries like India, and is there any way of measuring the material impact it will have on global trade? Let's get an expert who can give us these answers. Joining us now is Taimur Baig, MD and Chief Economist at DBS Group. Taimur, good morning, and thanks so much for taking the time out. Before we get into the serious discussions,
good morning.
Are you a Messi fan, and were you happy with what happened last night?
Well, I'm a fan of Messi. I'm also a fan of the Flying Eagles. So in a way, it was like a bittersweet outcome for me. You want to see the great man succeed, but you also want some African representation. At the end of the day, the better team won.
Okay. And no, this is the reason I thought I'll ask you this is because you came out with this very interesting note about how the world market trading activity quietens down quite considerably in the months of, in these 2 months, and this time around more so because of the World Cup as well. You've seen palpable signs of that.
Well, particularly in our part of the world, given the time difference, you do see, especially in our home market, which is Singapore, that all those late-night viewings seem to coincide with a drop in volume in the Singapore Straits Times Index. So we said that, since it happens every 4 years, it must be the World Cup.
Okay, interesting. And that's a very interesting note, by the way, for people who haven't read it. Do try and go out and read it. You can simply search it on the internet. It's a very interesting note. Anyways, Taimur, on to more serious matters. What's your view of this whole salvos being exchanged right now? We haven't seen too many material decisions except one or two. At least I didn't find them to be really big in the larger context. But they are pointing towards what could arguably turn out to be a nasty war if it actually goes down all the way. One, do you believe that this is more than posturing, and we could actually see the rhetoric from all the nations turn into a full-blown trade war? And if that were to happen, does it have the potential to do something really bad to the global growth, which is just showing signs of picking up?
Right. I think we should have absolutely no doubt that the advisors that surround the President of the United States are not doing it as a posture. They firmly believe that punitive tariffs are a fundamental way of correcting imbalances, and therefore there might be some degree of gamesmanship associated with the threats and counter-threats, but as far as amenability of the U.S. administration to impose high tariff on imports from China or European Union or Canada, I think we should take that very, very seriously. So that's issue one. Now, if we take that as a likely outcome, then what does it mean for global economic dynamic and investment? So I think the near-term impact, of course, will be felt in the markets long before it is felt in actual flow of trade and investment. And in terms of actual flow of trade and investment, what might happen more likely is postponement, because people do hope at the end of the day that these are short-term noise, it'll go away, and therefore their medium-term plans for a country or a sector would not have to be revised dramatically. For example, the Harley-Davidson story over the last 24, 48 hours that's been dominating the headlines, it's not necessarily directed to what the Trump administration is doing. They have a very large market in Europe and Asia. It makes sense for them to have more home-biased manufacturing there as opposed to importing things from the US. So we should sort of try to separate the noise from the actual drivers of growth. And there, right now, not that much. It's mostly on the rhetoric, mostly on sentiment. So I think the short-term impact is on the markets than on economies.
Interesting. Taimur, where does this leave the emerging market? One, in terms of sentiment, two, in terms of actuals. Actuals, I guess we'll get to know when we get to know. But has the sentiment dampened considerably? And are lead indicators like currencies, for example, giving you that indication that there could be more in store?
So let's put two things separately. One is the ongoing stress in emerging markets, which in my view is independent of the trade-related developments. The fact that US dollar is strengthening and US rates are going up is a 1-2 punch that very few emerging market economies running a current account deficit can endure. So they will see weaker currencies, they will see capital outflow. There's just no two-way about that. Now, you on top of that add this issue, then of course the bad situation becomes worse. We've already seen, particularly in Turkey and Argentina, a lot of stress. Venezuela, Mexico, Countries like these are under pressure as well. And here in Asia, we've seen currencies of India, Indonesia coming under pressure. These were going to happen with or without the trade-related developments. But mind you, when you look at economic indicators, including concurrent and leading indicators, there's actually not that much sign of a slowdown. We have a nowcasting framework for GDP here at DBS. So we look at, on a day-to-day basis, what the GDP estimate of India, China, Singapore, and countries like that are at this moment. We have this data all the way through the 22nd of June this year. And we see no palpable sign of a slowdown. Particularly in the case of India, domestic demand is actually perking up. So from that perspective, we don't see any slowdown. It's really in the headlines and sentiments.
Interesting. Does that give more ammo to the Reserve Bank or more confidence to the Reserve Bank to go ahead and raise rates further? Because if the MPC minutes, Taimur, are any indication, there is a consensus on the rate, even though there is caution on the future.
You have to have some sympathy for central bankers around the world, not just in RBI, but also in the Fed. They are cognizant of all the negative headlines around the world, but when they look at the data, and that's what they deal with on a day-to-day basis, they see no reason to step back from hiking rates. This is particularly true in the case of the Fed, but even in the case of the RBI, inflation markers are firming up. Growth is showing no sign of slowing down. Plus 7% in a world like this is excellent growth in my view. May not be as high as what India's aspirations are, but given what the world is like, these are great numbers. Under these circumstances, how can the RBI also sit on the sideline? So I do think RBI remains on a hiking mode, and the markets can actually live with that because they are doing it because they're comfortable with the economic outlook.
Interesting. So I do know that aside of being the chief economist, you have a fair bit of interest and experience of the equity market asset classes as well. How would you look at what's happening in India individually if you do track it as closely as you probably used to in the past? There's a bit of a dichotomy between what's happening at the broader end versus what's happening to a select set of names. Looking at what's happening on the macros, is your view on the Indian stock markets a lot more sanguine currently?
Well, look, given that there is a whole emerging market outflow dynamic in place, and we've seen that all across the board, not just in India, that both on the rates and FX and equity space, the ongoing macro developments have given investors a lot of excuses to sell or move away from EM positioning. So India cannot stay away from that dynamic, even if domestic demand markers are looking good. So our macro strategy team, so we look at rates, FX, credit, and fixed income and equities under one umbrella. We find it hard to be very constructive in emerging markets. On the emerging market spectrum, normally India would be at the highly vulnerable end because of its twin deficit issue, but I don't think this is the case this time. Simply because India's domestic demand, after remaining dormant for a while, has actually perked up in the last year or so, shrugging off the drag from demonetization and the introduction of GST, and I don't see that tapering anytime soon. And therefore, people who are looking at India's domestic demand markers or domestic demand-oriented stocks will probably find a buying opportunity right now.
Taimur, just the basic definition of C plus I plus G, it's only C which is working. The others haven't shown any material signs of contributing in any meaningful way in the years gone by, and from the commentary that we are hearing, even for FY19. So
let's break up the I into two parts, the government I and the private sector I. Now, the private sector I has been dormant for a while, but I do see markers of that picking up, particularly in the private equity space, and not just in construction, but in a broad areas beyond just consumer demand. Now, public investment has been very strong the last few years, but the government has sort of run out of space to push that any further given the deficit-related concerns. So what we might see going forward is some sort of a recalibration of the investment dynamic, where after a very long time we see some life on the private investment side, where after a very long time we don't see that much coming from the public investment side.
You think there will be meaningful investments by the private side in the first, in the remainder of the calendar year itself?
Well, the way I think about it is the following, that banking system, particularly public sector banking system, is a reluctant partner in capital formation right now, given the ongoing stress. But when you look at the balance sheet of private banks, and when you look at the non-bank financial sector in India, significant amount of lending is going out both to corporates and to individuals. And that's where I see the push for the economy. So there is a pull coming out from the PSU banking system, but finally we are seeing some push coming from from the non-PSU and non-bank sector. So that's why on the margin I'm somewhat hopeful.
Interesting. A recent interview that you did with Bloomberg Singapore, I presume, wherein you've given views that all is not well with the Indian rupee. Now it's clearly showing we are what, 30-40 paise away from hitting those lows as well. What's your thought, Taimur, on what the near term could bring in for the rupee?
There has to be more downside. I mean, how can an emerging market exchange rate, which is characterized by twin deficits, in this global environment right now, how can one have constructive view on that currency? So it's nothing to do with India, it's with the external environment and the fact that on the oil side, on the US dollar side, on the rate side, everything is US dollar positive and non-US dollar negative. The rupee has got to be a casualty. So I would not be a holder of the currency. I expect rupee to hit 70 before the year is over and perhaps even higher.
Well, in which case, Taimur, the other imponderable, of course, is crude, which stays buoyant as we speak. These twin blows might be very difficult for India as an economy, right? Crude at 75, 80 with the exchange rate, if I'm hearing you correctly, southwards of 70 as well. That doesn't augur too well for India.
That doesn't augur well for corporations who are highly leveraged on US dollar funding side. For them, obviously, if they have dollar payables and rupee receivables going forward, the going will be hard. But mind you, this is different from the slowdown that we saw 3-4 years ago when a sharp decline in commodity prices also had a very negative impact on the global investment and global demand dynamic. So commodities, whether you're an importer or an exporter, actually play a very large role in driving the overall well-being of the economy. In the case of India right now, you have buoyant commodity demand because the domestic demand is strong. So yes, that would mean stronger current account or weaker current account deficit. That would mean a weaker exchange rate, but that is not necessarily a function of a weak economy. That is actually a function of a fairly strong economy. So yes, by the laws of supply and demand, if India needs more dollars, the rupee has to weaken, and that's fine. But if it is based on the fact that the demand side is strong and that's why India is importing more, then it's okay. Now, the missing element here is, of course, fuel pricing policy. The local prices should move up and down with global prices, and that would act as a moderating influence on demand. Going into 2019 election, that's where the big challenge for the government of India is. Would it be comfortable allowing for significant upside to domestic inflation and domestic fuel prices so that the laws of economics work through the economy and not just keep prices artificially low, create even a worse problem for the rupee and the current account?
What do you think they should do, Taimur?
Well, it's very clear to me that countries that have a huge import bill cannot afford to subsidize consumption of petroleum products. It doesn't have to be a one-for-one implementation as far as domestic prices are concerned. In my previous life as a public servant, I used to work for the IMF, and I worked on energy pricing policy in emerging markets quite extensively. And the recommendation then from the IMF and today has not changed, which is it is fully understandable that in a country where people have modest means, you don't want significant volatility in pump prices on a day-to-day basis. So therefore, you come up with long-term moving average formulas. So let's say today's pump price should be a function of 200-day moving average of Brent or Dubai crude prices. From that perspective, you can have a fairly smooth, low volatility evolution of domestic prices without necessarily causing huge amount of consternation among the public or creating political costs for the government. I think that's the way not just India, but most emerging market economies should go.
Interesting. One last question, Taimur. If the managements that I interact with almost on a daily basis are to be believed, there is going to be meaningful revenue growth and possibly earnings growth as well that would come into FY19. Now, we all know that stock markets, while being touted as the barometer of the economy, may not necessarily reflect the entire economy, but parts of the economy which are growing well. However, that's the corporate India that I'm listening to, and that corporate India is sounding very, very bullish about growth coming back in FY19 or coming in FY19. Your lead indicators, frequent indicators, high frequency indicators, do they also point towards the same thing, that FY19, despite all the hiccups and the macro headwinds that we are facing, could well be that year of growth that India badly needs?
Right. So again, if we can just maintain plus 7% trajectory in 18 and 19, I think we will be doing very, very well. And when we look at real credit growth, when we look at auto sector activities, it gives us hope. We think that also the fact that there's a likelihood of procurement prices being raised, while it may not be the best fiscal policy in the world, it certainly would again add to the demand dynamic. So credit, agriculture, and what's happening in the auto sector gives us hope that we're not about to see any palpable slowdown in the Indian economy on the domestic side.
Well, cross fingers for that. Taimur Baig, thank you so much for taking the time out this early in the morning and talking to us, and look forward to having you in our studios the next time around.